Hello students, welcome to the brief description of week 9 topics. So during week 9, I would be covering topics on variance analysis and emerging issues in accounting. So as I already discussed, I will be discussing variance analysis, the most part of variance analysis in week 8. And this week I would be discussing about uh, that is in detail. I would be discussing about cost variance and revenue variances during day 1, and during day 2 variance reporting, disposition of variances. I will be discussing about what is disposition of variances. Then during day 3, I would be discussing about the same, that is disposition of variances. And during day 4, I would be discussing about emerging issues in accounting, that is the recent issues uh, in the field of accounting, that is human resource accounting, forensic accounting, sustainability reporting. So these are the topics that I will be discussing during these weeks. So now, what is disposition of variances? So variance may be disposed of in either of the cases, like inventories and cost of goods sold may be adjusted to reflect the actual cost, and variances may be transferred to the profit and loss account. So under first method, all variances are allocated between the inventory accounts and cost of goods sold account, and only actual cost should be recorded in cost of goods sold account and inventory accounts. And the supporters of this method will not favor standard costs as true cost or cost suitable for use in the profit and loss account, but as merely guides in factory management. Actual costs are the facts, and therefore they should be used in financial statement. And hence the first way, that is inventory and cost of goods sold, that have to be adjusted to reflect the actual costs, will be supported. Then variances from the standard are costs and not losses, and therefore should be reflected in the inventory valuations and the cost of goods sold. If the variances are large, standard costs do not represent the actual cost and therefore are not good measures to determine the cost of goods sold and inventory. So that is what the first method follows. The second method is variances are considered as profit and loss items in the period in which they occur, and the work in progress, the finished goods inventory, and the cost of goods sold are stated at standard cost, and unfavorable cost variances are deducted from the gross profit at the standard cost. So favorable cost variances are added to the gross profit calculated as the standard cost, and the treatment of the cost variances will be shown during the uh, regular classes. Okay, so this is what the disposition of variance under the second method, and standard cost will avoid the inclusion of cost due to wastage, losses, inefficiencies, excessive overheads from low production volume. Standard cost represents normal cost, and therefore inventory figures are conservative and acceptable for income determination and for other purposes. And in a multi-product company, it may be difficult to determine accurately how much variance should be distributed in each product. And in taking corrective action, managers will find it more useful when variants are depicted in profit and loss account. So managerial attention is usually hampered when variances are combined with cost of goods manufactured. So accountants who support this method believe that only standard cost should be considered the true cost. Variances are not treated increases or decreases in manufacturing costs, but as deviations from contemplated cost due to abnormal inequality, extravagancy, inefficiency or efficiencies, or even other changes in business conditions. And this viewpoint leads to the closing of all variances to income summary account, which is an acceptable procedure as long as standards are reasonably representative of what costs ought to be. And it is difficult to suggest which method has to be followed in accounting for variances. So if variances are large and significant, the first method, that is distribution of variances to the respective accounts, appears to be the more appropriate for financial reporting, tax, and job and contract pricing purposes. The second method may be preferable when variances are insignificant. Variances are insignificant. Thus, the treatment of variances depends on, so the treatment of variances will depend on many factors like size of variance, accuracy of standard cost, causes of variances like incorrect standard cost, timing of variances caused by seasonal fluctuation, or type of variance, that is material, labor, or overhead variances. And I also will be discussing about the managerial uses of variances. So determination of variances is the only step in the process of standard cost analysis. And just computing of material, labor, and overhead variances is useless for controlling cost and for evaluating the performance. The final objective of variance analysis is to determine the persons responsible for each variance and to pinpoint the cause or the causes for occurrence of these variances. So when this variance analysis is properly used, standard cost variances are useful tools for achieving effective cost control. That is, before management can take effective action for improving control over cost, it needs to know not only the amount of variances, but also where the variance has originated, who was responsible for that, and what caused these variances to rise. So analysis of standard cost variance is therefore necessary for responsibilities and causes. Now, what is analysis of variances by responsibilities? Control over cost must be applied at the place and time where the cost originates. Variances must be identified with the manager responsible for the cost incurred, who should be held responsible for that cost. The cost factor that is directly controllable by operating supervision must be separated from those cost factors for which executive management is responsible. Specific titles of individuals who are responsible for each type of variance differ among business enterprises. See, for example, material price variance. So the personnel who are responsible are purchasing agent or the purchasing manager, and materials quantity variances, the persons responsible would be the plant superintendent, the departmental supervisors, machine operators, quality control department, and the material handlers. Like that, for labor rate variances, personnel like department manager or department supervisor or the plant superintendent would be responsible. And for labor efficiency variance, plant superintendent, departmental supervisors, production scheduling department, quality control department, materials handlers, and machine operators will be responsible. For overhead expenditure variances, who would be responsible are, it may be individual foreman or supervisor who are expected to keep actual expenses within the budget. So that is for variable portion of the variance of overhead variance, the foreman or the supervisor will be made responsible. Fixed portion, it is the responsibility of the top management. So the same personnel who are responsible for labor efficiency variance will be responsible for overhead efficiency variance also. And the top management and production schedulers would be responsible for overhead volume variance. Then uh, analysis of variance by causes. So variances reflect the effect on cost which certain events or conditions have produced. So before management can decide whether or not action is called for, and if so, what has to be done, it is necessary to know what caused the variance to arise. And reasons for the variance should be determined and plans for necessary corrective action made either by discussing possible causes with the supervisors or by examining underlying data and records. So the analysis of variances by causes is therefore an important aspect of the use of standard cost to attain effective cost control. So for any standard cost variance, there are many possible causes like materials price variance, materials quantity variance, labor rate variance, labor efficiency variance, overhead volume variance, overhead efficiency variance. Okay, so these are some of the variances that are the possible causes for the cost variances. And analysis of variance by products. So since management usually wants current true cost when decisions have to be taken with respect to pricing and related questions, variances are often analyzed by products in order to arrive at current product cost. Companies producing non-standard goods according to customer specification may also help analyze variances by the job orders. The analysis of variances by causes is useful in deciding whether or not cost variances should be allocated to products in arriving at product costs for pricing. Standard product costs should be reviewed periodically and revised when it is found that the standard product costs in use are no longer useful for the purpose. So the next topic that I will be discussing is variance reports to management. So variance reports basically aim to inform managers responsible for the operation when actual performance differs from the standards. In order to be effective, the report must be timely, accurate, and clearly understood by the recipients of the reports. So control of production and cost in a manner of timing, the effectiveness of the control is often in direct proportion to the speed with which variances are reported. So timely reporting often requires daily and weekly reporting of the information related to the performance, and hence it is important to focus managerial attention on off-standard conditions immediately following each shift, day or week, rather than to accumulate and summarize variances from standards each month. So a month and generally even a week is too long a period for many off-standard conditions to remain unchecked and uncorrected because the time interval may prevent positive identification of employees who are responsible for the unsatisfactory work. Prompt review and variances can disclose conditions needing managerial attention and can also provide management with information which contributes to the making of sound decisions with respect to the future. So variance analysis reports, they are primarily the control reports. In developing and reporting the variances, it has to be remembered that results must deal with relevant distinctions. It should be understandable and it should measure with reasonable accuracy what they are supposed to measure. It should be presented and explained concisely, timely, and provide the amount of details needed by persons at each level of management. So this is about the disposition of variances that is going to be discussed in our classes. So now, after discussing the advantages of variance analysis and what is the purpose why variance analysis is done, how it is useful to the management in taking decisions, it is also important to know its limitations. The standard costs are not without the short. They are essential parts of the system of cost control, revealing deviations from a plan and indicating where responsibility lies so that corrective action could be taken. But standard costs have some limitations which should be kept in mind before using them. What is that limitation? See, the first is regarding the predetermined nature of standard cost. The accuracy of standard cost is bound by the knowledge and skill of the people who created them, and they contain the prejudices of their makers. So such badly conceived standard costs do not enjoy the confidence and the users of the system. Secondly, it is difficult to select a type of standard currently attainable, normal, that is, whether it may be ideal, normal, etc., which can help in cost control and achieving other managerial purposes. If standards are too low, they defeat the objective of standard costing and bring the operating efficiency down. If they are too high, they can create ill will and encourage employees to beat the system by fair means of time. There is also a dispute as to what level of standards should be used for external financial reporting and internal management purposes. And thirdly, a good program of standard costing requires that both management and operating personnel should have full confidence in it, and standards should be fair and workable. Educating employees is necessary in this regard. However, lack of acceptability, education, and communication is a major difficulty in operating a standard costing system. And there is the problem of human relation to add to the problems of setting up and operating the system. And sometimes this aspect is more involved in standard costing than the mechanics of the system itself. So in spite of all these limitations, standard costing has developed into an extraordinary and very useful tool and has contributed much in providing different kinds of cost data for so many different purposes. So students, we will, I actually, what is to be covered in class is already covered here about the disposition of variance analysis and the types of variance disposition of analysis, and how this the variances are useful to the management and the employees. So students, the other topics that is going to be discussed in this week are I'll be discussing about the recent issues in the emerging issues in accounting. The next topic that I will be discussing is emerging trends in accounting. So the accounting industry is no stranger to the challenges. Accounting industry also has to face different challenges due to the current socio-economic climate. Even more issues have been emerged. Accountants need easy fixes, and we also have the solutions. And a substantial challenge in accounting was moving services online, with many accounting firms developing a remote work approach as the industry called for virtual accounting. By utilizing the right tools and proactive measures, numerous firms were able to mitigate the effect of these challenges and be successful. But those that did not adapt to new ways of working felt the consequences. So, and the the field of accounting also is facing the challenges, and the accountants have to be prepared to face these challenges. So some of the challenges that are faced by the accounting professionals are, see, cloud-based technology is taking over, and there is, you have to manage the cyber security, and also it's very important to manage the client data, and automation and the accounting skills has to be synchronized. Then the remote work and expense management also has to be taken care of. So these are some of the challenges that the accounting accountants are being uh, are facing. Like every other industry, the fintech sector is evolving rapidly regarding systems and business processes. So, for example, the certified public accountant exam is in that is a exam. The conduct emphasizes automation, analytics, and data-driven mindset. So some of the challenges are the emerging trends of the accounting uh, field are that is here actually there are so many challenges that the accounting field is being faced, but in the syllabus we are going to emphasize on forensic accounting, human resource accounting, and the sustainability reporting in accounting. So first we will discuss about human resource accounting. So what is this human resource accounting? So human resource accounting, it is the process of identifying and reporting investments made in human resources of an organization that are presently unaccounted for in the conventional accounting practice. So the contribution by the human resources, so it is not accounted for in the accounting practices, conventional accounting practices, but measuring the value of human resources can assess organizations in accurately documenting the assets. So who we call as human resources. That is, human resource accounting, it is a process of measuring the cost incurred by the organization for recruiting, selecting, training, and developing the human resources. So that is what is called as human resource accounting. So what is the purpose of human resource accounting? So the main aim of human resource accounting is to generate cost and value information of human resources by measuring and identifying the data, that is the human resource data, that is why what is the cost incurred by on the human resources. So whatever the cost that is being incurred, are we going to that is reap the benefit out of the cost incurred by the human resources, are the benefits are exceeding the cost incurred on human resources. Okay, so this human resource accounting, it is used to develop the financial assessment of people in the organization during a particular time period. So, and it is also about evaluating the economic result of investment in the people. So, the purpose of human resource accounting is it allows the management to effectively monitor the use of human resources in the organization, and it controls the appreciation, depletion, and conservation of human resources. It furnishes the cost and value information for making management decision regarding acquiring, allocating, developing, and managing human resources. So the American Association of Accountants defines human resource accounting as it is a process of identifying and measuring data about human resources and communicating this information for the interested people. Now, why? What is the purpose of objectives of making human resource accounting? So, it fulfills the preparation of human resource accounting or maintenance of human resource accounting fulfills some of the objectives, like it produces information of cost and it values human resources. It effectively monitors the use of human resources. It appreciates the depreciation of human resources. It provides the cost and value information. So these are some of the objectives why human resource accounting is maintained in an organization. So advantages of human resource accounting are It helps in decision making. It helps in identifying the strength and weakness of the existing workforce. It measures the effectiveness of the HR policies. It helps investors judge a company. It also measures the return on investments. Like that, there are different types of human resource accounting. Um, which like methods of human resource accounting, which may be historical cost method, replacement cost method, present value method, and economic value method, then asset multiplier method, which are some of the methods that are available for human resource accounting. So next we will be discussing about forensic accounting. So what is forensic accounting? So students, uh, forensic accounting means it is the use of accounting skills for investigating fraud and embezzlement and to analyze the financial information for the purpose of legal proceedings. So some of the examples of forensic accounting are financial theft. It may be by customers, employees, or the outsiders. So if any kind of securities fraud by the organizations, okay, the time of bankruptcy, if the companies are defaulting on their debt, if there is any economic damages, mergers and acquisition related lawsuits, and fraud in tax evasion, and if there are any kind of corporate disputes, valuation disputes, then the forensic accounting will come into picture. So it means that investigating the fraud or any kind of financial manipulation by performing extremely detailed research and analysis of financial uh, information. Okay, forensic accountants, they are of they are often hired to prepare for litigation related to insurance claims, insolvency, divorces, embezzlement, fraud, and any type of financial theft. So I will be discussing this in detail during our regular classes. So the next topic that So